In this video, we're going to discuss some of the basics related to convertible preferred stock. Convertible preferred shares are fixed income securities that investors can convert into a certain number of common shares after a predetermined time span or on a specific date. The fixed income component of convertible preferred offers a steady income and some protection of invested capital. Recall, preferred shareholders get dividends prior to common shareholders and also have a priority claim on assets in the event of bankruptcy or financial distress. The conversion option gives preferred shareholders the opportunity to gain from a rise in the share price. It's this upside potential that will entice convertible preferred shareholders to accept a lower dividend yield. Some things we need to keep in mind about convertible preferred stock. It's a potentially dilutive security. In other words, it can reduce our earnings per share, which we will take a look at later in this chapter. It's classified as part of stockholders' equity unless there's a mandatory redemption. That is, the firm can force preferred shareholders to redeem their shares or convert their shares. If this is the case, then it's classified as a liability. Since there's no theoretical justification for recognizing a gain or loss when preferred shareholders exercise their option to convert their shares, firms use the book value method to account for the conversion of convertible preferred stock. Let's take a look at some examples. We're told that the Indigo Corporation originally issued 2,500 shares of $100 par value preferred stock for $102 per share. Each share could be converted into 4 shares of $10 par value common stock, and investors convert 1,000 preferred shares into common stock when the common stock is trading for $27 a share. Let's go ahead and record the issuance of the preferred shares. So originally, Indigo received $255,000 in cash. That's the 2,500 shares times an issue price of $102 per share. We record the preferred shares at par value, so we'll credit preferred stock for $250,000, and the difference we will credit to paid-in capital in excess of par for preferred stock. At the time of conversion, the market price or fair value of the common stock doesn't matter from an accounting or bookkeeping perspective. Of course, it does matter to preferred shareholders. They're not going to convert their shares if the common stock is worthless or has a very low value. They will only convert their shares if they're better off from a valuation perspective holding common stock than preferred shares. We're told that 1,000 shares of preferred stock are converted into common stock, so we need to remove the preferred stock at par from our books, so we will debit preferred stock for $100,000. We also need to remove the additional paid-in capital that was recorded at the time the preferred shares were issued, which was $2 per share times those 1,000 shares. We're going to be issuing 4 shares of common stock for every 1 share of preferred stock. So we'll issue 4,000 shares of common stock, and the common stock has a $10 par value. So we'll credit common stock for $40,000. And of course, the difference is our plug to additional paid-in capital.